What if your mortgage outlived you and your kids, and you still couldn't afford a backyard? Because that's basically the direction we're heading when politicians start floating 50-year mortgages at the exact same time Wall Street is quietly buying entire neighborhoods like they're Pokémon cards. Welcome back to the comment section with Thomas Paul, where we look at the American dream and ask, okay, but is this a dream or a subscription plan with late fees? Today, we're breaking down how ultra-long mortgages plus Wall Street landlords could turn you into either a lifetime renter or a lifetime debtor. Who wins, who loses, and what you can realistically do besides screaming into a pillow. Let's start with this 50-year mortgage thing, because on the surface it sounds kind of nice, right? Hey, you can finally afford a house. We just stretch your loan to half a century. Tiny detail. You'll be paying it off until Social Security is a rumor and your knees are made of titanium. Here's the sales pitch. Longer mortgage equals lower monthly payment. That part is true. If you borrow, say, $400,000 for a house on a 30-year mortgage at a fixed rate, your monthly might be in the ballpark of, let's say, around $2,100 to $2,200. Stretch that to 50 years at a similar rate, and your monthly could drop by a few $100. Sounds great when you're staring at rent, student loans, a car payment, and the price of groceries that look like they were imported from Mars. But here's where it gets interesting. What changes when you stretch that loan from 30 to 50 years isn't just the monthly payment. It's everything else. Your principal, the actual amount you owe on the house, gets paid down way slower. For a long time, you're mostly paying interest. You're basically renting the money. Over 30 years, you already pay a ton in total interest. Over 50, you can easily pay hundreds of thousands more over the life of the loan. You get smaller monthly pain, but a much bigger total bill. It's like signing up for a gym membership that's cheaper per month, but the contract lasts until you die. And here's the key. By lowering that monthly payment, you're not just helping buyers. You're also giving sellers and banks permission to jack prices even higher. If more people can afford the monthly, that pushes up what people are willing to bid. The system adjusts. It always does. And it's wrapped in this heartwarming language. We're helping first-time homebuyers. Sure. And I eat salad for the croutons. So let's zoom out. Because 50-year mortgages would just be one more piece in a game that's already tilted. Right now, single-family homes, the classic starter home with the sad fence and the questionable carpet, are not just bought by families anymore. They're being scooped up by massive institutional investors, real estate funds, REITs, private equity firms, and corporate landlords. These guys roll up with cash offers, no contingencies, and algorithms that scan listings faster than you can type Zillow. At one point in late 2021, institutional investors were buying around 18% of homes in the U.S. housing market. In some cities, especially in the South and Sunbelt, it was way higher. Entire subdivisions built from the ground up to be rentals, never for sale to normal families. And this isn't charity. They're not doing homes for humanity. They're building portfolios of rental income that they can slice, dice, and securitize. Turn into rental-backed securities they can sell to pension funds, insurance companies, and anyone else looking for steady yields. Your rent becomes a data stream. That data stream becomes a bond. That bond gets traded on Wall Street. And somewhere in there, your landlord is incentivized to raise the rent every year like it's a religion. Now, you've probably seen the meme, "You will own nothing and be happy." And yeah, a lot of the conspiracy stuff around that is, let's call it creative fan fiction. But underneath the over-the-top doom, there's a real structural shift. We're moving to a usership model. Subscribe, don't own, for everything. Cars, software, movies, music, your coffee maker, and now, potentially your house. You don't need some shadowy world government to explain what's happening. You just need profit incentives, cheap financing, and a bunch of institutions that realized, wait, if people are basically forced to live indoors, that's the most captive customer base on earth. So where do 50-year mortgages plug into this? Here's the uncomfortable answer. They make this entire machine more profitable and more stable for institutions. Imagine you're a big fund. You love long, predictable cash flows. You want to know what money is coming in for as far into the future as possible. The longer the loan term on mortgages, the more those cash flows look like a nice, smooth bond. 50-year mortgages mean people can qualify at higher prices. Monthly payments look affordable on paper. Asset prices, home prices, have room to float higher. The underlying loans can be packaged into longer-dated securities and exotic products. In simple terms, stretch the maturity, inflate the asset. And it doesn't just affect people buying homes, it affects people renting them. Because when homes are treated primarily as financial products, not shelter, every lever is pulled to juice returns. If house prices are high and locked in for 50 years on the mortgage side, rents need to stay high or keep going up to justify those valuations. So you get this weird world where a starter home isn't really a starter anymore. It's a permanent asset on some institution's balance sheet or a 50-year chain around someone's neck. You used to buy a starter home, pay it down, build equity, maybe upgrade. Now, starter homes are becoming endgame homes. The stepladder is getting yanked up. But wait, it gets even wilder. Think about the winners and losers in this setup. Winners, banks and lenders. They get decades of interest payments instead of 30 years. Longer streams of cash. More products to sell to investors. If you were a bank, you'd pine for 50-year mortgages like a teenager for concert tickets. Developers and builders. Longer loan terms mean people can afford higher prices, so builders can list homes for more. And if individuals can't swing it, institutions will buy the whole development and turn it into build-to-rent. Institutional investors and Wall Street landlords. The longer and more predictable the payments, the more bond-like the housing market becomes. Housing isn't just property, it's a yield machine. Your home turns into a spreadsheet cell. Losers. First-time buyers. Congrats, you finally qualify. For a house you might finish paying off at 78, assuming no job loss, no health disaster, no divorce, and your HOA doesn't randomly decide the pool needs a $30,000 facelift. Families trying to move up. You bought a place, but prices ripped higher around you. Now upgrading means taking on an even bigger debt load, probably at a higher rate, for even longer. Trapped in the starter home that was supposed to be temporary. Renters. Even if you never touch a mortgage, you're impacted. As institutions set the floor for prices, landlords can point to market rates to justify bigger rent hikes. Your paycheck? That's not keeping up. And then you get all the knock-on effects. Wealth inequality grows as those who already own assets benefit from inflated prices, while those outside get frozen out. Rent pressure eats more of everyone's income, leaving less for savings, investing, having kids, or starting a business. Political anger builds because everyone's told, the economy is great, inflation is cooling, while their rent went up $400 and the only thing they can afford to buy is a folding chair. This is the part where a lot of videos just go full doom. It's over. You'll never own a home, move into the woods, become a mushroom. We're not doing that. Let's pivot from we're screwed to, okay, given the game board, what can you actually do? First, renting might not be failure. In a world where institutions are overbidding, prices are stretched, and loan terms are mutating into 50-year chains, it can be completely rational to rent, especially if your job isn't stable or you might need to move. Your local market is wildly overpriced relative to rents. You're not ready for surprise costs, roofs, HVAC, termites, lawsuits from the HOA because your door is the wrong shade of beige. The old line, renting is throwing money away, only makes sense if 1. Buying is reasonably priced, and 2. You stay long enough and pay down enough principal to make the math work. If you're about to sign up to pay half your income for 50 years just to not throw away rent, congratulations, you've just upgraded to throwing away interest instead. Second, if you do want to buy, get brutally honest. Think time horizon. If you're not planning to be somewhere for at least 7 to 10 years, buying can be risky, especially if prices are elevated. Transaction costs alone can wreck you if you have to sell quickly. Think job and income stability. If your income is variable, commission-based, or you're in an industry where layoffs are trending, be extra cautious about signing up for decades of fixed payments. Think total cost, not just payment. Property taxes, insurance, maintenance, HOA fees, assessments. Owning is not just the mortgage. A house will find ways to bill you. Third, consider house hacking if your market supports it. That might look like buying a duplex, triplex, or fourplex, living in one unit and renting the others. Renting out a room or a basement to offset the payment. Turning part of the property into a separate unit if local laws allow it. It's not glamorous. It's not always Instagrammable. And yes, tenants can be a pain. But turning your shelter into a semi-business can be one of the only ways regular people can compete in a market dominated by big money. Fourth, if you can't own property directly, you can still get some exposure, very carefully. REITs, Real estate investment trusts let you invest in real estate through the stock market. Some specialize in single-family rentals, others in apartments, commercial, industrial, data centers, you name it. They are not magic. They can go down. They have risk. But if Wall Street is going to turn housing into a yield product anyway, one way to fight back is to at least own some slice of the machine that's otherwise steamrolling you. Just be clear on what you're doing. You are investing, not buying a house. The risk is different, the rewards are different, and you can absolutely lose money. Fifth, build a stronger balance sheet while the system sorts itself out. If buying a home right now in your area looks insane, you can hammer down bad debt, credit cards, high-interest loans, build cash reserves, an emergency fund, then maybe a down payment fund. Improve your income, skills, side hustles, career moves that give you more leverage over time. Because here's the thing, this housing system is unstable. High prices, high debt, institutional concentration, it's fragile. We don't know exactly how or when it breaks, but systems like this don't go on forever in a straight line. When something finally snaps, rates, prices, regulation, you want to be the person with cash, flexibility, and options, not the person that just signed a 50-year mortgage at the peak because a politician said it was helping the little guy. And please, for the love of whatever you pray to, be skeptical of zero down, no money, no problem, TikTok schemes. If someone's entire strategy is leverage up to the moon right now, ask yourself why they need you in the deal so badly. So let's bring this home. We were sold the American dream as work hard, buy a starter home, pay it off by middle age, build equity, retire with some stability. What's quietly being built instead is sign up for a 40 or 50-year loan, watch institutions bid against you with cash, and if that doesn't work, rent back the same kind of house from a corporate landlord whose business model depends on squeezing you annually. Home ownership becomes less about security and more about servicing a financial product. Your dream home isn't just your shelter. It's someone else's asset, someone else's bond, someone else's quarterly earnings story. 50-year mortgages are the perfect symbol of that shift. They turn the biggest purchase of your life into something that behaves like a subscription. You're not buying a home, you're subscribing to one. And that's the real question. Do you feel like a citizen in a country or a customer in a giant housing-as-a-service platform? So I want to hear from you. Would you ever take a 50-year mortgage if it meant you could finally buy a place? Or does that feel like signing a financial prenup with your future self, where you know you're the one getting screwed? Do you feel like home ownership where you live is even realistic anymore? Or are you leaning into the millionaire renter path, building wealth in other assets and just refusing to play the housing game on nightmare mode? Drop your local reality in the comments. What are rents doing? What are starter home prices like? Are you seeing corporate landlords or build-to-rent neighborhoods pop up? I'm reading through these because the disconnect between the headlines and what you're actually living is massive. If you got value from this breakdown, hit like, make sure you're subscribed to the comment section with Thomas Paul, and turn on notifications so you don't miss the next episode. In a future video, we're going to dig into millionaire renters versus over-leveraged owners, who actually ends up better off, and how to pick your lane without ruining your life. Until then, protect your money, protect your sanity, and remember, a 50-year mortgage isn't a dream. It's a business model. The question is, are you the customer or are you the product? I'll see you in the next one.